Coming to you from the Tar Heel State, this is the Carolina Commercial Real Estate Connection, bringing you industry insights and hot takes from Carolina real estate experts, helping you begin, grow, and scale your commercial real estate portfolio. And now your hosts, Tony Johnson and Cameron Pearson.
Good morning to all the aspiring and active commercial real estate investors out there. Thanks for tuning in to the Carolina Commercial Real Estate Connection. If you enjoy the content from our show today, please like and subscribe to our channel.
Today we've got Brian Mitchell. Brian has over 2 decades of finance experience in the mortgage industry and is here to shed some light on recent events in the financial markets, as well as the Feds and plans on what rates and what he sees will happen here in the future. Hope you enjoy the show.
Welcome to another episode here, the Carolina Commercial Real Estate Connection. Today we have Brian Mitchell with us. Brian, how you doing today?
Doing great. How about you guys?
Good, man. Thanks for being here today. I really appreciate it.
Absolutely.
So, Brian, tell us a little bit about how you got into the where you are now. What was your foundation and start out look like?
Sure. So I'm in the mortgage business. I've been in it for about 21 years now, and actually started out as an engineer by training, and was a mechanical engineer in college. That was my degree, and then I worked in engineering for about 10 years. And that's what brought me to Wilmington, and just happened to move in next door to a guy who was starting up a mortgage company, and he was a pure sales guy. He didn't really have any technical or organizational side to him, so he asked me for some help, and so I did some things for him, helped him do his website, and as I watched his business grow, I just got more and more interested in finance and mortgage, and then I actually did the nighttime MBA program at UNCW. My engineering company put me through that. And in your second year project on a local business. And so I did it on his company in the mortgage industry. And so I learned a lot more about mortgages and finance, and just got really interested in it. And he was growing his company really fast and needed some more help. So I decided to make the jump back in 2001. And here we are.
There you go. So you got to ride that 2004, 5, 6 train right in the mix of before the big downturn. So I'm sure that was a pretty big eye opener.
Oh yeah. Yeah, it's up, down, up, down.
Oh, yeah, good stuff. But the engineering background for mortgages, the details is very important. So that's good.
Yeah, that has helped me a lot, just bringing a little bit more analytical side to the business, because most of the business is made up of just true salespeople.
Yep.
So
And so what do you do? What is your position right now in your mortgage company?
So right now I work for a company called Integrity Home Mortgage. We're an independent mortgage banker based out of Winchester, Virginia, and my role is the head of sales. So I spend a lot of my time just helping salespeople structure loans, various sales techniques, how to implement different marketing strategies. I do kind of monitor the financial markets and try to help educate our sales folks on what's going on in that space. And also do a little bit of recruiting as well.
That's funny. Now, when you picked up, if we go back a little bit, so when you were picking up with your neighbor here and he got you into the mortgages, how long were you in just doing the mortgage side?
So I kind of came into his company really to kind of do what I'm doing, well, to run the operations. My job there ended up being an operations manager. But I came in blind, right? I didn't really know anything. I had been studying this stuff, but I hadn't actually done it. So the first thing I did was come in and just start originating some loans and reaching out to friends and family, and started doing loans. And I learned the business really quick. I mean, it's really, to me, the best way to learn. And so, after, 6 months in, I had a pretty good grasp on how the industry works and the process flow. And then I just kind of started expanding from there, and I'm kind of a nerd when it comes to just trying to learn as much as I can about whatever it is I'm doing. So I just did a ton of reading and talking to people, and just figured it out on the fly.
Typical engineer, right? I'm assuming when you were doing the origination, did you stop there, or did you dig deeper and figure out what was the full processing of the loan? Did you work on figuring out all that?
Yeah, so I would go sit with all the different department heads and actually sit and watch an underwriter underwrite a loan, sit and watch a closer close a loan, watch a funder, send wires and fund the loan. So I tried to figure out every aspect of the process. And yeah, that's, again, just kind of trial by fire. And that's really how I picked it up.
That's awesome. So when you were doing these loans and figuring out the underwriting, have you ever dug much into doing any underwriting on your own? Have you ever done any investing in real estate on your own besides like your home?
Yeah. So I've bought and sold a couple of investment properties, and I currently own 2 investment properties.
Awesome. Where are those investment properties?
They're in Wilmington.
Keeping it local.
Yeah.
Yeah, that's easier to control with your illness.
And I've owned one that was 7.5 hours away as well.
Ooh,
And that was, that's kind of a challenge.
Yeah.
And are those long-term or short-term?
I've never done short term. Well, actually, I take that back. The one that was 7.5 hours away was a vacation cabin in Gatlinburg, Tennessee. So I did a lot of short term there, but here in Wilmington, they're both long term.
You were going through the mortgage industry, sounds like you really started pulling towards the macroeconomics, the piece of being the engineer where you're going to read into and learning all the rates and why they change and what they do. I think you'd probably be a pretty good one to speak on that, right?
Yeah, that's kind of my the part of the business that fascinates me the most is the secondary market side, right? What's driving interest rates, as well as what happens to mortgages once they're originated. How are they packaged and bundled and sold, and what drives that side of the business is something that really interests me.
Wow, that's definitely interesting for somebody from my side. Obviously, I don't have a great understanding of that, so I'd love to learn more about it. So when a loan is closed with you guys, can you walk us through the next steps?
Sure. So we're an independent mortgage banker, which similar to your union and mortgages, guaranteed rate. We're not a depository, so we don't take deposits. So we can't hold loans on our books. So we have to sell all of our loans. So we sell our loans into what we call the secondary market. So there's different investors. Fannie Mae and Freddie Mac are one of those. Most people are probably familiar with those 2 government-sponsored enterprises. So we sell some of our loans to them. And then we sell some of our loans to what are called aggregators. And the consumers don't really necessarily see this side of the business. That's why they call it the secondary market. But that would be bigger companies like a Penny Mac or an AmeriHome or a Chase, for instance. They'll buy loans from us as well. And ultimately what happens to those loans, whether Fannie Mae and Freddie Mac buy them or whether these aggregators buy them, is they all get bundled into bonds, which are called mortgage-backed securities. And then those mortgage-backed securities are sold on Wall Street. And that is kind of a cycle of mortgage finance.
Yeah, absolutely. And that's kind of where, when we were selling all these packages back in 08 and 09, when they were doing the undocumented loans back there, that's kind of, these packages were being sold off and then kept on going up. And then I think that's what kind of created that financial crisis. Do you foresee any repeat of that in the current market conditions?
I definitely don't. And that's great that you bring that up. If anybody's seen The Big Short and they're interested in how this stuff works, I highly recommend that. And you might have to watch it 2 or 3 times because it gets pretty deep on some of those financial vehicles. But anyway, I don't see that happening at all. And it's kind of funny if you if you watch various media outlets or you find people on Twitter, you'll see people out there that are kind of putting that narrative out there that, oh my gosh, we're heading for another crisis. There's going to be this housing crash. And in my opinion, is that could not be further from the truth because of a couple dynamics that are just different from 2008. So the thing that drove 2008 great financial crisis, the main thing was risky loan products, right? So the industry was just putting out products that were not sustainable. People were not going to have the ability to necessarily repay those loans. Adjustable rate mortgages that could get increased significantly in interest rate, negative amortization loans where you're actually not even paying back the interest. So your loan balance is going up. Other products like stated income which started out as a noble product. It was for self-employed people that write off a lot on their taxes. But then it got to the point where, somebody from McDonald's could state their income and say they made $100,000 a year,
Right.
and there was no validation of that whatsoever. When I knew it was getting ugly is when they were offering 100% stated income investment property loans. And it just makes absolutely no sense, right? Like zero skin in the game, zero verification of your ability to repay. In the industry, and this is kind of driven from greed at the Wall Street level all the way down to loan originators. Everybody had a piece of it, but it really started with extreme greed, right? And what happened was that, the thought was, well, house prices are just going to keep going up. So none of this really matters. If I put you in at 100% financing, the house's price is going to go up, right? And you'll build some equity and everything will be fine. And if we have to foreclose on the house, there'll be some equity there. But as we all know, the music stopped, right? And house prices were just accelerating way too fast. And so they're super risky products. So as soon as house prices stopped accelerating, people stopped being able to make their mortgage payments. And then we got into this foreclosure, and it's a spiral down. So that piece, and then that drove just extreme inventory, right? With all the foreclosures, there was way too much inventory. And so house prices can't sustain themselves in that environment. So we had a big drop in prices. The difference now is, number one, the Dodd-Frank Act, which came out in 2010, it sort of legislation got rid of all these risky products. So now you just can't as a mortgage company, you cannot originate a mortgage without showing an ability to repay. It's a law, it's called ATR. And so they've legislated away all these risky products. So the underwriting standards now and the credit quality of all the loans out there is significantly better than it was back in the run up to 2008. So you got really high quality loans. And then you've got house prices, which again, some people are trying to push this narrative of house prices are going to drop. There's just no way they can drop fundamentally because of the laws of supply and demand. So there just isn't enough inventory right now. And anybody that pays attention to housing knows that, right? Even in this market, with as high as interest rates are, there's still bidding wars for just about every nice, decent house that comes on the market. So there's just no way prices can drop when there's more demand than there is supply. And that's really the challenge for the industry right now. There's two big challenges: is interest rates and inventory. And our industry's been in a recession for about a year now. And until one of those things breaks, it's going to be hard to come out of it. So I don't see any chance of a repeat of 2008. And the other interesting thing, I wish I could show this chart. I love how it showed you visually. Is people say, well, we're going to have a recession, right? I think everybody agrees there's most likely a recession right around the corner. We can talk about that if you want. But then people say, well, house prices are going to drop. And if you look back in history, the last 8 recessions, house prices go up every time, every single time, except for one, 2008. But that's an anomaly because it's actually house prices are what appreciated and are part of what caused that recession. So you kind of got to throw that out. But you look at every other single recession and house prices only go up. So,
yeah, I would agree with that. Now, I would actually agree with everything you've said thus far. I think, the difference in this environment from that one is that was single family residence and residential mortgage crisis type, right? The difference in this, where you're going to have that, in my opinion, is kind of leads back in where we're doing most of the focus on commercial stuff here. Is the commercial loans are completely different than the residential loans and how they're structured. They're a shorter term balloon loans, 5 and 10 year term balloon. And those 5-year terms that were done in 2018, 19, 20 are going to be coming up. And then when they're coming up now for a refinance or a sale, and the rates have doubled from when they financed it, then you have a large loss in value, or when they're refinancing, they're going to have to bring a tremendous amount of money to the table, to cover everything for the bank. So that's where there could be a lot of, financial instability with the banks. That could be a concern more than the residential housing with those refinances, and then the majority of small community banks are going to be affected. So the larger banks, don't do a lot of the commercial lending. It's all these small community banks. That's where I think on a, economic foresight where we would see a kind of a banking crisis come into play would be with all the smaller banks.
Yeah.
Would you agree with that?
Yeah, I agree. You guys, when I say you guys, the commercial side, 'cause I know you focus more on that. I think there's some pain. There's definitely pain coming, right? The combination of, like you said, the resets, those are going to be super painful because, like in residential, people are just holding on to their 3%.
Right, you got the 3%. I mean, so though the economy's not turning as great, everyone got so much money from the valuation increase of their house and have been able to leverage that, with maybe a home equity line or a second, and if you've done it in the, if you need the money to get by, you can get by, you're just kind of holding out. So I think, with consumer debt going at an all-time high right now, people are definitely getting by. I don't know that they've caught up to that, but I don't know that going back to your point, is going to make the home prices crash because there is no inventory. So I don't see that happening.
Yeah, but in 2008, I think people. Now it's almost an earth, there's a billion earthing, but there's only about 1 million available.
Yeah.
So it's nowhere near, you're right, the same picture in OH is completely different. Now, the other side is people focus on the last thing that broke the system. So now there's other pieces that can still break the system, but again, residential.
A piece that's going to break the back at this point, I think it's going to be the crucial real estate if something came through and broke the back. Just because, when you're doing all this economic research, you look at the bonds and how their relationship is to shorter to long, the 10-year bond to the shorter term bond, and how when they go and get close, and then if they invert.
Yeah, that's an interesting, like talking about recession coming up. So a yield curve inversion, right? That's when short-term rates go above long-term rates, which doesn't make any sense. Normally, if you're borrowing money, longer you're borrowed at higher return, you would expect. So rates typically are higher for a 10-year, say, than a 2-year treasury. But we've been inverted for several quarters now. And that's usually one of the leading indicators of a recession coming. And
typically when that invert then flips back is when we know that we're entering the recession.
Yeah.
That's historically speaking, I think, right? So that's what you got to watch for right now. They're like 50 basis points apart or something. Is that about right?
Yeah, it's a big gap.
Yeah.
And then, back to the commercial side, I think you guys have, from a supply demand standpoint, there's a lot of supply, right? And the demand and I don't know a ton about commercial, so just correct me if I'm wrong, but with the whole remote work thing, right? So a lot of these commercial office buildings are sitting partially occupied, really high vacancy rates. And then you got, as you alluded to, these mid-sized banks who typically lend on those. They're getting squeezed right now, right? We saw the little mini banking crisis we had a couple months ago with several really big bank failures. And so bank credit is tightening up. So anybody who's in the commercial space trying to borrow money, all of a sudden they're finding tighter underwriting terms, right? Higher LT or lower LTVs, more skin in the game required. And of course, the rates are much, much higher than they were. And then all the resets that are happening.
Yeah, well, so to go back to your point, it's market specific. So the only where office is really getting hit bad right now, the top places are, San Francisco and New York. Those are down about 40%. And transactions are down, I think, 70%. But in our market here, we don't really have an excess inventory of office. So there is not a lot of office depreciation. As a matter of fact, I just was in a bidding war for a half burned down office and lost. And then I just put in an offer this morning for a piece of land that I would do, multi-tenant office or retail. And I thought it was a reasonable offer, and I got an email back that there were 3 other offers already. So, the market around here, it's still, it's always, it's small pockets. So they overbuilt residential, for instance, they overbuilt in Arizona, pockets of Arizona, pockets of Texas, where now they're having some excess inventory, but nationally as a whole, there's definitely no excess inventory, right? So
Yeah.
and with the rates going up, all that's going to do is that slowed down new development. And so then you're just gonna, aggravate the situation worse and continue to push that value up. So it's a big, difficult situation to understand. So it's great that we're sitting here talking about all these economics, because if we can figure it out, we'll all be in great position. We just gotta get ahead of this situation. And the other thing about our area here in the eastern portion of Carolina, we have so much money coming in that I don't think that we've even gotten close to hitting our cap. So the values of commercial real estate, everything that I'm looking at and that's coming across my desk that people are sending me or that comes out on the MLS. I mean, a lot of these items that are being traded right now were purchased back in 1920, and they're listed and going under contract 3 times the price that they were bought in 19, right? And so there's nothing that's even been done to the property.
Right.
And so, it's just the growth here is phenomenal. So everyone's trying to get in, and we're really turning a corner as an area that on a national stage, if I don't know if you guys saw, we were moved up to number 14 in the country in growth. So, this is a great area. So when you're looking at macroeconomics, what other things do you study that we could get some more insight from you on? I feel like you've got a lot of insight into it.
Just looking at kind of what, again, I look at everything that drives residential interest rates, which, translates also similarly to commercial. So like we talked about the supply demand equation. What's one thing that's hurting, keeping rates high right now? Obviously the Fed, right? They've raised short-term rates 5% the last year and some change. The big question is, what are they going to do going forward? So my personal opinion is the Fed is a little bit backward looking. They're not looking forward. And I think they've gone a little bit too far. The question is, they're trying to engineer the soft landing, right? So they've got the dual mandate of they want to keep inflation right around 2% as their target. And they want maximum employment.
So do you think that the path that we're headed right now is got inflation on a trajectory to get back to 2%?
I think so. I mean, whether it gets all the way to 2 in the next few quarters is to be determined, but it's definitely coming down. I think we're somewhere we'll call it mid 4s, and it depends on which measure you look at. Or you're looking at core or the overall inflation, but somewhere in the mid 4.5. We hit 9, right? That was so that.
Yeah, but real world. I mean, I understand they'll use they artificially tamp these things, though, is the problem when you're looking at these. So, we pulled from strategic oil reserves to kind of get that to slow down that, right. So they just kind of tweak it to give this headline number. Then they give an adjusted number on everything, a month later, but they only come out with that first headline number, right? And nobody ever comes back and here's the adjusted number, right? They never come back to that, which is an issue. So, as far as, you have so many prices that have gone up with just a grocery store. I mean, I can't even go to the grocery store anymore without spending $400, and then I don't even get everything that I need. Right. Because half the stuff's not even at the grocery store. Because they don't have it anymore or something. They can't get it.
Supply chain.
Supply chain. Yeah. So, it seems like it's a difficult, place to go through. So it makes it a difficult environment. So if we could get back to 2%, if you feel that would be great. I think that my issue is the government is spending so much money, and now with the rates going up with our national debt, they have to keep spending more money just to pay for all of the programs and the debt. So, I feel like the Fed's fighting a losing battle, because how can they really tamp inflation when we're just putting so much money out?
Right.
So, I mean, you think that we are still gonna be able to get a stranglehold without them cutting spending? I know they were gonna not raise the debt ceiling now. They put a pause on that, whatever that means.
Right. Yeah, it's awesome.
Pause it. We're gonna pause it until after the next election. So the rate, it can just go up, but we won't vote on it.
Yes.
I think was the philosophy that they went with.
Yeah,
You know,
good luck stopping the government spending, right?
right.
But I think, I think what's gonna get inflation back down is gonna be a recession. So, that's the question, is there gonna be a soft landing, or are we gonna have a recession? And I think just about any economist is gonna say, we're definitely heading for a recession. Might be there now, right?
Right, and the soft landing, I think, has left the building.
Yeah, I think so. And especially with the Fed still talking about raising rates. I mean, some of the Fed members are saying we still need to raise again in June. Some of them are saying we need to, we maybe pause in June and look at the data, which is, they really need to look at the data. And the data that they look at, I think, is the rear view mirror versus forward looking data. And so I think if this recession happens, well, actually, let me take a step back. The debt ceiling piece, right? That was an aggravator of interest rates. That jacked interest rates up. I mean, we were trending down in around 6%, maybe sniffing the high fives, and then all of a sudden, the banking crisis and this whole debt ceiling thing happens. Now we're up over 7 again, right? And it's really putting a damper on the residential market. I think we're hopefully past the debt ceiling, at least the part that has concerned the markets and jack rates up. So now, what's going to happen with with a recession? The biggest thing right now in terms of what's going to drive that is employment. So employment is still very strong. Unemployment rate is what, 3.5%, somewhere there.
Still very strong.
Now what typically happens is the employment rate is at a bottom at the start of a recession. So that's kind of that's where we're at, right? If recession is going to happen. But that's really what's going to drive residential rates down is employment. And I hate for people to lose their jobs, but it's just part of the natural economic cycle.
So what's got to happen to stop inflation?
Right. I mean, the technology sector on the West Coast is definitely right.
Yeah.
A lot of these larger companies are doing layoffs now. They're not substantial layoffs, and it's not again not going all the way across the country where it's really affecting the economy as a whole. These layoffs. So, yeah, I'm with you. So this is definitely a different animal than any I think of us at our age have experienced. It's very, there's so many unknowns on what's going to fall and how that's going to affect everything else. For someone that's investing in real estate, commercial or residential, it makes you pause on, what's the right avenue when I'm underwriting a deal and looking at a deal, what's the avenue on how to underwrite this long term. So the advantage with the commercial is, if you can get a piece of property that cash flows, then you can suffer through the storm and come out on the other side. So it's important, I think, right now to look at buying quality real estate as opposed to buying for value increase. It'd be the same for residential real estate, I think, but just buying good quality real estate that you want to hold on to for longer term. You're not going to do a lot of going in and flipping. So no, the house flipping, I think, is out for a while. And I think the commercial go in, fix and flip, or do a quick value add and turn it over is going to be kind of out the door for the short term.
Yeah, I would agree with that.
So what do you like to do normally here in Wilmington? How long have you been here, did you say?
I've been in Wilmington since '97. So I've seen a lot of growth. And I try to enjoy all the things that we have to offer in Wilmington. Love the water, love to get out on the boat, fishing, just kind of pleasure cruising. I've started to enjoy downtown a lot more lately. We just recently moved our offices downtown. So I usually didn't go down there as much because it was kind of a hike, but there's a whole lot of good stuff going on downtown.
Yeah, that really
It's really well area, but the whole downtown as a whole has really completely changed. I was actually down there last night at the Dave Matthews
Oh, yeah.
concert, yeah, and it's the venue's amazing. I mean, everything is so clean and nice, and to have, you know, such a big artist come to town is pretty impressive for our area,
Yeah,
you know.
yeah, that amphitheater is, I mean, that is,
Yeah, that's a good spot.
world class might be a little strong,
But-
but it's.
but-
for us,
but-
It's moved up.
Yeah. You do not have to leave the area and hear, you know, great national artists. So let's go through to your personal experience. So if you could go through in your, you know, mortgage career, if you could say, what was your biggest mistake or error that you feel like you made that maybe you could share to help somebody else that's getting into that industry that, you know, maybe could help them from making a bigger mistake?
It's a good question. All right, so I would say, and this is almost more of a life lesson, you know, as much as it is a business lesson. So I was working for a company that was owned by a bank, and the bank decided they wanted to get out of the mortgage space. So they told my boss, hey, you know, we're getting out of mortgage. You need to go find a home for your group. And we had about 140 people, company based out of Raleigh. And so they went out and searched all these different national companies, and they landed with one in particular. And so we just got a call one day and said, hey guys, we're all going to work for company X. And we didn't know anything about them. So I started doing a little due diligence, and there was a couple red flags. I was a little concerned. And at the end of the day, it ended up being a disaster. After about a year, almost everybody had left that bigger company that swallowed us, and we scattered in different directions. But the lesson to me was, at least in this industry, I'll never go work for a company where I don't know, like, and trust the leadership. And again, I think that can apply in just about any industry. I mean, sometimes you have no choice, right? I understand that. Like, you're not always going to know the CEO of a Fortune 500 company. But our business is pretty small, and you can get a good idea for how, you know, how people are, even if you haven't necessarily met them. So I've always given people that advice when they're looking at jumping around. Our business is very dynamic. People move around all the time for different reasons. But whenever somebody's making a move, I always say, just, if I was you, make sure you know, like, and trust the leadership, at least as far up the chain as you can go. Because if you go into a blind situation within, again, any company, a lot of times you get, you know, broken promises. And I hear that story so many times. Like, I thought I was making a good move, and then I got in there and I got under the hood and realized things aren't as I thought they were going to be, or they told me they were going to be. So yeah, that was probably my biggest. Again, I didn't really have a choice. I guess I could have gone to
Right.
left my group and gone to a different direction, but that was probably the biggest setback of my career, is just making a bad move to a bad company.
Yeah, it takes a while to recover from that. So you were there, and obviously you said then you moved on. How long, once that transition happened, were you in there before you moved on to a different company?
It took a year.
Oh, that's,
Yeah.
and so basically the amount of people that transitioned over, would you say 80%, 70%? What was the percentage that left within that time frame you left?
Well, out of the 140, I think there's probably about 10 or 12 of those people that still work for that company. So it was, yeah, a bunch of them left quick, like after a couple months.
And it typically takes 6 months to really see what you got. And then after a year, you know whether it's going to be able to work or not, which is what I think you probably assessed 6 months and said, no, let me see if I can pull this off. By the end of the year, you knew it wasn't changing. And that's typically what I tell people too. If you jump on and change, if you got to give it some time,
Yeah,
but you'll know 6 months, 8 months in.
that's right.
So going back to your economic stuff that we were talking about, where do you get all your economic information? You listen to the news, do you read books? Do you have a favorite author that does economic books or anything that you read or keep up with?
Most of my stuff, I'm kind of a podcast nerd, so I follow a few industry specific podcasts, and there's a couple of economists that I follow. And so the MBA, Mortgage Bankers Association, they put out a lot of good material for our industry, and their chief economist, a guy named Dave Fractoni, I think is his name, very just no fluff. He's just very straightforward, and he just looks at the data, and no spin, just very factual based, sort of tracking the data. So he's really good. There's a industry podcast called Housing News, Housing Wire. That's always got some good data. They've got a really good economist. There's a gentleman named David Stevens, who used to be the head of the MBA. He used to head up FHA. He's again an industry guy that I just highly respect. Just very straightforward.
Yeah, I just went through a 1 hour seminar with him.
Oh, really?
And he's talking, it was amazing. The knowledge he brings more on the data. He just looks at the data and he shows you what's happening, which he's another one that agrees there will not be a housing crisis.
Yes.
Yeah,
I'm not saying there's not a recession coming.
yeah, I think the housing is not gonna happen, but it is, look at these guys that are the most successful in economics. You got Howard Marks, these guys that have done all the research, and all they do is track the historical data for hundreds of years back. And they're the ones that you got to listen to, these guys that really done the research. I'm not familiar with these guys you're talking about. As long as you're following the people that have been researching this for long-term historical reference, it's typically, even though we haven't experienced it, you can always find something to compare it to, and then, that's going to be the most reasonable explanation of what I think is going to happen.
Yeah, yes, I think, the people that follow data and don't have an agenda, it's kind of the agenda to pay attention.
The lack of agenda helps.
Yeah, lack of agenda definitely is.
Brian, thank you so much for coming on. This has been great information. We appreciate your time for sure. You're a busy man, so your insights, it's great. Thank you.